So about a week ago or so, CTV put out a great article on their website about estate tax. And it was a great illustration to show that a lot of people simply do not understand how estate taxation works in this country. Now, there's already a lot of great videos out there debunking or showing how misleading this article is. So I'm not going to go too far in depth on that. Instead, what we'll do here is we're going to break down how different types of accounts or property is taxed at taxation and what could be done to prevent said taxation. Let's get into it. All right, so here's what we do know. There's a $715,000 RRSP, a $660,000 tax bill, and a cabin. Now, the article certainly doesn't go into any of the details of the cabin, makes it almost feel like the whole tax bill came from the RSP, which is simply not true, but let's go through piece by piece. Let's start with the RRSP. If you are passing away and you still have a spouse or a common law partner, you can transfer an RSP 100% to your partner. That's a fully tax shielded transfer. Now, while that transfer is tax-free and it lands in your spouse's accounts without paying any taxation, there is absolutely still tax consideration because you have just transferred from the couple's tax economy to the single's tax economy. So just very simple example. If I'm retired with my wife and I pull $50,000 of income and my wife pulls $50,000 of income, we are each taxed as a $50,000 income person. If I die and Lauren inherits everything and she pulls $100,000, she's taxed as a $100,000 income person, which is more total taxation than two people with 50, right? So when you have a spouse pass away, yes, the transfer is tax-free, which is a huge, huge win, but you are absolutely going to be paying more taxes going forward. Now, alternatively, if you're single or your spouse has predeceased you, the entire RSP amount is going to go into your estate. You can also name kids directly, although I don't generally recommend that. I recommend the estate, but 100% of the value of the RSP is going to be considered taxable income when it does that. This is rough, and this is going to be the highest tax bill you see in this entire video. So let's go over here to Ernst & Young's website. This is a totally free website. You can go to it anytime. I'll put a link in the description down below. If we put $715,000 of income and look at the beautiful province of Ontario here, we have a marginal tax rate of 53.53%. This is the third lowest marginal tax rate in the entire country, behind only Newfoundland and Nova Scotia. And trust me, you do not want to be compared to Nova Scotia. That province is rough on taxation. The other thing you'll notice here is that the average tax rate is 47.29%. This is why I always use 50% when I'm talking about your estate taxation rate. A, I don't want to say 47.29% 100 times, and B, there's no way I can do mental math on that number. So we're just going to use 50% for the rest of this video because it's close enough. So what could they have done to prevent such a severe tax bill? Really, there's two approaches to it. Number one, the article implies they should never have done RSPs in the first place. So option one, we jump in a time machine, we go back, we tell them never to do RSPs. But even here, I think there's a lot of shortfall to that advice. That means that they're not going to be enjoying the tax benefits along the way. And from my perspective, the point of the RSP is to be advantage to mom and dad. They were earning, I would assume, larger income in their working years than their retirement. I don't actually know that. But assuming that is true, they're getting a larger tax refund then for what they're paying now in retirement. The fact that they happen to die young and a large tax bill shifted to their kids is obviously not ideal. But if the priority is themselves, they're not as worried about their kids on the other side. So I still think RSPs make a lot of sense. The other thing they could do is what's called an RRSP meltdown, which is when you're taking extra from the RSP in your early retirement years, money that you don't technically need for your spending, and you're piling that extra into TFSAs or non-registered along the way. Now, the couple in the article died incredibly young. It's a tragedy. They may have been in the middle of a meltdown strategy, but even at $715,000 of RSPs remaining, if they each wanted to take $50,000 per year to kind of control their taxation, there's still 7, 8, maybe 9 years of RSP remaining, depending on what the markets are doing. So yes, they may have been in the middle of a meltdown to help themselves down, but I don't think anyone transitions into retirement, or not many, thinking, oh, we'll die at 63 or 64 years old. So we simply don't know if they were attacking that type of strategy, because the reality is a strategy like that is minimum 10 years, maybe 15, because if you did it in 1 year, it's exactly what they just did, and there's no tax advantage to it. All right, time to move on to the cabin, because this is where the article really does get misleading. It doesn't talk about anything to do with the value or what the cabin was originally purchased for. Now, we can speculate all we want on how much the cabin was worth or even where it was. I don't think there's any point to that. But believe it or not, the information that we had at the beginning gives me enough information to figure out what the total gain was on that cabin. But first, we need to figure out how tax works on a cabin. So if we just imagine that this represents the total gain that a cabin has. So you purchase it for X, it sells for, or in this case, you die, and it's deemed disposed, which means the day before you actually die, the government considers that you sold it that day. The difference between those two is the gain. Half of that gain will be exposed to taxation. And then that amount is exposed to your tax rate, which in this case, we're using 50%. So the total tax bill on the cabin is half of the total gain, or 25% of the gain. So we just need to figure out how much of this total $660,000 tax bill came from the cabin, and that's actually quite easy to do. We know that the RRSP was $715,000. We're using 50% as our assumed rate, which means $357,500 of that tax bill came from the RSP. The remaining $301,626, therefore, came from the cabin. So if $301,626 is the total tax bill on the gain of the cabin, and that's 25% of the total gain on the cabin is $1,206,504. But wait, there's more, because the article goes on to talk about the fact that they own the cabin for a total of 27 years. 22 of which it was a secondary property where everything I was just talking about applies. The last 5 years of ownership of that cabin, it was the primary residence. So it's completely exempt from all the different taxation that I'm talking about, meaning that the $1,206,504 is only based on the 22 years that it was a secondary property. And the reason that we can take that number and extrapolate it to the 27 years is because CRA thinks it's a linear growth. I know, you know, that in reality, the growth that happened in 2022 or 2023 was significantly more in terms of dollars than the growth that happened in 2001 or 2002. But CRA can't be in the business of micromanaging every single year. So they just say the total growth happened in a linear fashion. So if 22 years was exposed, 1.206 million divided by 22 is $54,841 per year of total growth. So now we add 5 more years in, and the total gain that this cabin experienced was $1,480,709. Now, like I said before, we can speculate on what type of cabin this was. Maybe it was worth $2 million and now it's worth 3.5. Maybe it was originally 100,000 and miraculously now it's worth 1.6. We don't know. So for the sake of the rest of this video, I'm just going to round the $1.48 million number and say that the cabin is worth 1.5 million and they magically bought this cabin for 20 grand 27 years ago. So now, because the cabin was deemed disposed the last day of their life, that transitions into the estate. The tax bill then will get paid, and now the brother and sister do inherit the cabin. The nice thing is what they inherited is a cabin with an ACB, or an original cost base, or an adjusted cost base, of $1.5 million. Meaning they could turn around right now and sell that cabin for $1.5 million and pay zero in taxes because there's no growth on that value. But how could we have avoided the $301,000 of tax in the first place? There's a couple of different ways. None of them are perfect. They all have different kind of pros and cons. Number one, they could have done some sort of joint ownership years ago where the kids, maybe once they got to age 30 or something like that, or even just into their working years, they could have come on as joint owners of the cabin. This actually would have triggered a deemed disposition anyways. Granted, it would have been likely a much smaller deemed disposition, but there still would have been a tax bill at that time. So that's not necessarily perfect. You can do something called an estate freeze, where the cabin kind of locks in its current value and goes in trust for the family. But really, unless you're talking about a very, very large estate, all you're doing is just kicking the can down the road of a tax bill, and it's eventually going to catch up to you anyways. And the last way that I recommend, and I see this as definitely the most common, is life insurance. Life insurance is probably the most common because it's the most straightforward, right? If you're doing a deemed disposition and creating joint ownership or doing an estate freeze, you're doing complicated things that could trigger significant bills. Whereas you can go and get a life insurance policy and just pay for that for a number of years. And then, to be clear, you're not removing the tax bill. You're just shifting who's paying it to an insurance company. In my family, this is exactly what we did. I'm very fortunate that not my dad, but his grandfather or my great-grandfather built a cabin something like 70 years ago, and it's been torn down and rebuilt since then. But I know, and we all know, that there's eventually going to be a pretty significant tax bill to get access to that cabin. So when my folks were in their late 50s, maybe early 60s, they got a joint last-to-die insurance policy based on what we speculated the tax bill will be probably another 10 to 15 years from today. And the intent behind it was that me and my two siblings would pay that bill. Now, my parents pay that bill. They don't let us do that. That's a whole other kettle of fish. I'm sure one day we'll take it over. But if you own a cabin and your kids are in their 20s or 30s, maybe this is a great idea for you. Or if you are a kid and you're seeing that your parents have a cabin that's going to come down to you, maybe this is a great idea to bring to them, because life insurance can be a very, very cost-effective way to shift the responsibility of that tax bill onto somebody else. Now, what about other types of accounts? Well, some of you out there have non-registered investment accounts. A non-registered investment, a cabin, a rental property, they're all treated the same. You're going to be paying on the growth, half of that's exposed to taxation, and then multiplied by your tax rate. There's also tax-free savings accounts. And believe it or not, it's right in the name. It's tax-free. It's going to transition down into your estate tax-free. And to be clear, I'm not including probate in any of these conversations because it varies so wildly from province to province. So I just don't want to include it at all. So back to the actual case at hand. The brother and sister team in the article are inheriting $715,000 of RRSPs plus a cabin that's worth at minimum $1.5 million, meaning that the estate they're inheriting is $2,215,000 or more. And now that $660,000 tax bill works out to 29.8% taxation, or less, of course, if the cabin's worth more. Now it doesn't seem quite so unfair to be paying such a large tax bill. If it's time for me to review your tax strategy to make sure your kids don't get punished on taxation, or just to make sure that you're maximizing the dollars of your investment portfolio, there will be a link in the description down below that comes directly to me. Till next time, keep planning.